Good evening to all the participants. On behalf of Bandhan Mutual Fund, I extend a warm welcome to all of you to today's call on the equity market outlook. We are pleased to have with us Mr. Manish Kunwani, Head Equities and a well-known figure in the mutual fund industry. He manages multiple funds at Bandhan Mutual Fund and brings with him deep insights and experience. Today, he will walk us through the current equity market outlook and what investors can expect going forward. Before we begin, please note that all the participants will be in listen only mode during the session.
Hi, thanks everyone. Thanks for your time. I will take a few minutes to present our market outlook. Just one second, let me share the presentation. Ashish, can you confirm if this is
Yes, the presentation is visible.
sure? So, when we're talking of the market outlook, what we have done is basically divide it into categories based on time frame. So, let me first start with uh, the 10, 15 very long term view, only two big points here. One is that the Indian household balance sheet, to our mind, continues to remain strong. Why this is important is that recently there has been some slowdown in growth, and we have heard that a lot of banks and NBFCs have faced some issues in terms of the loans to personal loans and retail loans. We think that is just a blip. Um, it is not a systemic problem. And the second reason why this is important is obviously when we are looking at equities, one factor is how strong can domestic flows being going forward. We all know that roughly about 30 to 50,000 crores per month has been flowing into equities for the past few months. So some people are concerned that this is uh, this is a bubble kind of thing. We don't believe that. So if you see the balance sheet of the households, real estate is obviously very difficult to estimate, but we've just taken a rough estimate by agency. But other three are quite precise. So, Ashish, is the audio clear? Couple of people in the chat box are saying audio is not clear.
Yeah, I am able to hear you clearly. Srishti, uh, yes, audio. So it might be a person specific problem, I believe.
Okay, okay.
No, I can hear it clearly, Manish.
Sure, sure.
Yeah.
Thanks. So, when we see the four big assets which are owned by Indian households, they roughly now total up to 900 to 1000 lakh crores, with real estate being about half of it. And gold has increased almost double in last 2 to 3 years. So from about 125 lakh crores, the value of gold held by Indian households has gone up to 250 lakh crores. And that is obviously helping the overall wealth of Indian households. If you see, even the loans against gold, that has shot up to almost 12 lakh crores. Uh, and it is growing quite fast. So, while gold is not something which Indian households typically use as a consumable thing, but via gold loans, etc., it is definitely helping the expenditure of households and helping the economy. In fact, India is a very peculiar country because our credit card loans are one fourth of gold loans. I don't think any other country has that dynamic. Um, so, so it is important to see this overall household balance sheet, as I said, to look at what kind of consumption strength is there, to look at what is the state of the banking and NBFC system, and also from a equity market perspective, what are the kind of flows that can come. So if you see the bank deposits of roughly 120, 130 lakh crores, they grow at about 10-12% per year, which is about, let's say, 14, 15 lakh crores. And 40,000 per month is on an annual basis about 5 lakh crores. So when we are predicting that this roughly 40,000 crores per month will keep flowing in, essentially what we are saying is between gold, bank deposits, even if we get a fraction of the increase in the value of these asset classes, then 40,000 crores per month is not a big number. So, this is the first point that while some segments of the population may have a challenge in terms of the balance sheet, but when we see at a aggregate level, so at aggregate level, the balance sheet of the household seems quite robust, and we are hopeful that consumption, which has been relatively weak for last few years, given that interest rates are coming down, tax cuts have happened, pay commission may happen, we are quite hopeful that over the next 12 to 18 months, we should see a revival in consumption. This is the first point from a long term view. The other important point is when we see equity returns, people are obviously concerned on valuation, GDP growth, corporate earnings, and we discussed a lot of these things. But one interesting thing is when we want to see where we are in terms of equity returns from long term perspective, the best indicator is actually how much has equities given above inflation. So what we call real return. That is a better predictor of equity returns in the long term rather than GDP growth, interest rate, etc. And this is true not only for India, it's true for almost every market. So if you see US and Japan, which grow at very different GDP growth rates, but if you see long-term data, 10, 20, 30 years, the real return, that is the return above inflation, always converges to around 5, 6%. And this is a good way to see Indian equities also. So if you see the 10-year return of Nifty 500 above inflation, it tends to converge back to 6%. Um, so right now we are at 7% odd. And in that sense, it is true that valuations are a bit stretched. Uh, Clearly, the valuations indicate that you can't be too greedy about near-term returns. Having said that, purely because of valuations, we are not very defensive on equities uh, because the macro scenario is very positive for India, and which I will come to in a bit. So the overvaluation is not so dramatic that we need to change core allocation to equities. It is something to be kept in mind that we are in a phase where the 10-year return above inflation is more than the average of 6%. But clearly, 1% above 6% is not something which should dramatically change our asset allocation, particularly keeping in context that a lot of the things we see from a macroeconomic perspective, those are positive. So I will come to that part now. When we talk of macro, first of all, see, it is not growth that is exciting. Typically, when we say overall things look good, the first reaction is to believe that growth is great. But honestly, I don't think that GDP growth, either in the world or in India, will surprise too much on the positive side. And there are two big reasons for that. The biggest is demographics. And demographics is a good indicator because the data can't change very fast. So it takes generations to obviously change demographic data. And therefore, it is a fairly certain thing to happen. Now, in this chart, what you're seeing is basically what we call the birth rate. The birth rate is something where if it is less than 2, it means that population will um, peak out or has already peaked out. Because 2 is simply that father and mother need to produce 2 kids to replace themselves. That's the simple logic. Um, Now, if you see any region which is not blue, is essentially where birth rate is less than 2. And what you will notice is most of the developed world, whether US, UK, Europe, Japan, China, they're materially below 2, which means that populations in these regions will obviously peak out soon or have already peaked out. And that is actually fairly well known. But what is probably not so focused upon is that even India has a demographic issue in the sense that our overall birth rate is 2, which means population will not, at overall level, decline very fast. But when we see where economic activity is high, typically in the south and west states, which comprise almost 50% of India's GDP with 30% of the population, there the birth rates are similar to Europe or Japan. So states like Tamil Nadu, AP, Telangana, the birth rates are 1.4, 1.5, or some even less than that. So, for example, it is believed that Tamil Nadu will start degrowing in population in about 5 years, and a lot of the other south and western states will follow Tamil Nadu. So, clearly, when the world's population is peaking out, it is very difficult for GDP growth to accelerate from there. Uh, Clearly, economic activity is uh, labor into labor productivity. Now, labor is number of hours or number of days worked. And if that itself is going down, the productivity improvements can't be very dramatic. So, this is one reason. The other reason, which is also because of clearly in the headlines, is that uh, free trade is going down. So, from 1980 to 2010, there was a golden age where free trade picked up. But now we are obviously entering a era where every country wants to do certain things themselves. So the efficiency is going down. See, free trade is very good because every country does what they are good at. Um, Unfortunately, in protectionism or when free trade is reducing, it means that we are not doing things in the best possible manner. Um, but due to security considerations or whatever, that is definitely happening. And this also is negative for growth. So, the real reason to our mind is why we need to be positive on equities is more because India's macro stability will lead to higher valuation multiples. So, what we mean by macro stability is essentially when we see the Indian currency, for example, uh, last 30, 40 years, it has depreciated 4% per annum. And that has kept our cost of equity high. So, what we mean by cost of equity is basically when cost of equity is high, your P multiples are low. Uh, Now we think the rupee will do much better versus the dollar at least, and that is going to lead to higher P multiples because globally capital will go where the asset and the currency return combined look attractive. So if the currency is doing well, then obviously more capital will be attracted. And why this is happening is after many decades, are what we call current account, which is basically your total exports, total imports. What is the gap? India always has had a situation where our total imports were more than our total exports. So there is what we call a current account deficit. But the great thing for India is that last 5 6 years, our biggest export services has gone up. Our biggest import oil as a percentage of GDP has gone down. With the result that if you see the red line, which is our current account, it used to always be 2 to 3% minimum of GDP. Now, first time structurally, it is becoming zero. So, current account is probably the most important variable for currency. And if a country is going from perpetual 2 3% deficit in the current account to zero, that is a big improvement, and that should normally that should lead to much better performance of the currency. So as I said, versus the 4% depreciation we have seen in the rupee for last 30 years, we think it could be 1 or 2% going forward. And that clearly is very attractive for foreigners. Um, we also have to see what is happening to the US dollar fundamentals. And they are really bad in the sense that if you see the US current account deficit is 3 to 4%, whereas we have almost reached zero. The inflation gap, you see, US used to be 2% inflation, we used to be 6, 7, so the gap used to be 4%. Today, US is more near 3, we are more near 4, so the gap has come down to 1 or 2%. And most importantly, US, the debt is gone berserk. So you can see that the debt to GDP is highest since the World War, and the fiscal deficit doesn't seem to come down. Lot of measures which Trump thought will get the fiscal deficit down, which were things like reducing the expenditure on war or cutting government expenditure, the DOGE as it was called. Nothing of that is working. On the other side, we've got a big tax cut bill. So now the forecast is that US fiscal deficit will continue at 6%, which ideally should be 2 to 3%. And that will keep pushing the debt to GDP higher. And why it is significant is that given the size of the fiscal deficit, which could be $2 trillion, at some point, just like Japan, I think US may be forced to monetize the debt. What we mean monetize the debt is basically the central bank, the Fed, will have to buy the debt through what is called QE, quantitative easing, where they buy government bonds from the market. Now, clearly, if they do that, that is negative for the currency, which means dollar will be weak. So our view is both on both sides. When you see the rupee versus US dollar, the rupee is seeing a structural fundamental improvement in current account. The dollar is facing very bad macro numbers, current account deficit of 3 4%, fiscal deficit of 6 7%, debt to GDP of 120%. And because of this, we think that PE multiples in the Indian market will be higher than in the past, because the risk associated with Indian market versus the risk associated with the US market, it will be seen to be much less. So this is, to our mind, the most important reason why, in spite of valuations being high, we are not defensive on equities. So these are fairly long-term thing. Let me just come to slightly what we are seeing on the ground as of now. Um, so last 4 5 months, the dollar has depreciated broadly 10%. So what we say the dollar index used to be 110 peak, now it is 99. And while politics has played some part in this, it's also that uh, the US data is disappointing, not in absolute terms, but see, markets move versus expectation. And what you see here is what we call the economic surprise index, in the sense that uh, it is all this data which comes out, PMI, auto sales, electricity consumption, etc. All that is measured against what was expected. And if it is disappointing, the line is falling. If it's doing well, the line is rising. And you can see that over last 6 7 months, the US data has been disappointing versus expectation, whereas Europe and China data has actually been improving. Um, so there seems to be a reversal of many years where the rest of world was always underperforming US on growth, and expectations have now reduced in Europe and China to the extent that even without any big bang growth, the data is coming out to be better. Whereas US, because it has been doing well for last 10 years, now the expectations are high. And at this point, the US data on growth is slightly disappointing. India, again, we've been through a very patchy phase. 2024, second half, the slowdown was there. This calendar year, till May, things were recovering well. Last 2 months, again, there's been a bit of slowdown, partially caused by the weather, of course. So the early monsoon has hit many consumption industries. Um, but as I said, given that interest rates are going down, tax cuts, pay commission, etc., we think that within 12 to 18 months, we should see the economy come back reasonably strongly. That is obviously a prediction. There is no 100% guarantee on this. But if you see, our portfolios are more geared towards domestic economy strengthening and consumption coming back rather than being positive on global sectors. Um, so, some of the key issues now, obviously, one is tariffs. And to be honest, we've not been right on this in the sense that, so first of all, we do think that overall tariff rates will not be very high. Um, Essentially, I think US is in a weak spot because the debt is high, dollar is weakening, and it will be very difficult for US consumers and US businesses to have both tariff and dollar weakening at the same time, because the price they pay is obviously determined by both of them combined. So if you have 20% tariff and dollar falls 5%, effectively in dollar terms, you're paying 25% higher. Um, that looks very difficult. So overall, we think that most of the negative news on the tariffs is gone. Of course, relatively, we have been negatively surprised about what is happening at this point of time with this 50% tariff on India. I think a very, very high probability we are giving to the scenario that this is temporary, and we will go back to more normal tariffs, which could be anywhere between 15 to 25%, because that is where most of the countries are. Uh, so, so while there is risk that these very high tariffs may sustain, Now, see, these high tariffs frankly don't affect the economy in the short term because I think India exports about 80 90 billion to US, and the general assumption is pharma will not be under tariffs because generic pharma helps the relatively poor people in US. So politically, it does not seem to make sense to have big tariffs on pharma. Also because there are not too many alternative sources. See, textiles you can go to Bangladesh or Vietnam, but the size of the generic pharma industry which India has, it's very difficult to source that from other countries. So if you remove pharma, uh, maybe 30, 40 billion, which in a 4 trillion economy, really, even if that slows down by 10% or whatever, it is not something which is a big impediment in the short term. But I do think it's important to get this tariff thing sorted out because more from a long term perspective, clearly India needs to move people from agriculture to manufacturing because that is when growth will come. And to employ so many people, you need manufacturing to pick up. And clearly, US is the biggest economy in the world. We can't. I mean, it's obviously not a good place to be where uh, you're not able to export materially to the biggest economy of the world. And given that US also needs a counter to China, we do think that over next few weeks, most likely this tariff of 50% will be materially reduced. So that's our view on tariffs. See, global growth wise, I think Europe is a bit of a dark horse. They are opening up the government purse strings. They've announced spending on defense and infrastructure. If that comes through, along with some stability in China's growth, so even if US slows down a bit, given the tariffs and interest rates being high, we're not so we're not of the view that US tariffs will lead to a global depression or a big global slowdown. Because see, ultimately, US is hoping to generate about 300, 400 billion from tariffs, which for their economy of 30 trillion odd is 1% of GDP. So at a macro level, I don't think tariffs by itself will massively slow down the global economy. We still have, as I said, more hope from the Indian side that now that monetary policy is relatively dovish, interest rates have been cut, but they've not transmitted to the users fully, um, along with exchange rate being competitive. Ideally, we would have liked the government to be a bit more aggressive on fiscal spending. To my mind, they have slowed down a bit too early, and that is obviously part of the reason why the slowdown is happening. Uh, we hope that in case the slowdown is there, the government will again start spending, even if it means that the fiscal deficit will go up. I think one important thing is in this whole global game, I think we should monitor the yuan because clearly the focus of US is primarily China. Now, till now, the yuan has been very stable. But in response to US tariffs, if China chooses to depreciate the yuan, then I think that's a risk because typically, like if you go back to 2015, when yuan depreciates swiftly, all emerging market currencies will have to peg themselves partially to the yuan because no one will want to lose manufacturing competitiveness. So if yuan depreciates, I think that is not a great thing. Though if it's not depreciated till now, I doubt if there is a high probability, but it is something we need to monitor. See, valuation we can look at various ways. Obviously, we talked about the long-term measure of real returns, where valuation is slightly above average. But if we see different measures, I think more or less we are okay. P multiple is a bit high, but as I said, if our cost of equity is coming down, then that is okay. India recently has actually underperformed emerging markets, so our P multiple compared to EM price to earning multiple is actually now quite attractive. What is probably not fully in place for a big bull market is typically big bull markets start when there is some global volatility and there is some big financial accident globally where because of which credit spreads go up. Clearly, at this point, we are not in that phase. So it's not like a Lehman or COVID bottom, obviously. Uh, so as I said, we should not be very greedy on near-term return. Personally, I'll not be surprised if the market doesn't do anything for next 2, 3 quarters. Because see, last 3, 5, 10-year returns have been very high, and things tend to mean revert in equities. But at the same time, I don't think a big drop is also likely given the strength of the currency, etc. So, from a liquidity perspective, things again are mostly positive in the sense the biggest variable for liquidity is dollar, and dollar has fallen 10% from the peak. The rest of the things are also in India's favor, like crude oil is down, monetary policies are easing, gold holdings have improved balance sheet. Retail activity has been cleaned out, I think, largely. A lot of things SEBI did last year, plus this Jane Street thing and all that, which means F&O activity is quite low from the retail side. There is obviously a lot of supply coming, which is the reason I think next 2, 3 quarter big returns are unlikely. Uh, Now, obviously, the supply is very dynamic in the sense that if market corrects, it will stop. Uh, but we clearly have a lot of good IPOs actually, which are $1 billion plus in the pipeline, and those are likely to make sure that market doesn't go up too much to our mind. So, if I have to just summarize, long-term indicators on valuation bit stretched, but macro looks good. One of the contra views we have is that if you have 3, 5 year kind of time horizon, the small cap space is the best space to be. The reason being that, as I said, the growth is at a macro level is going to be very scarce, both globally and in India. And therefore, big industries may not grow very fast, like banking or utilities or FMCG or IT services. And large companies, since they already have big market share, they are unlikely to give any big positive earning surprise. So the real growth, I think, is going to be in niches, starting with smaller companies. So there might be quick commerce, there might be EMS, there might be power capex, there might be defense. All these spaces typically start with most of the companies being in the small cap space, and unless we ride those themes, being very static in large cap, I don't think can generate very high returns. So what we like from a long-term perspective is small cap or thematics like innovation and financial services, which tend to grow quite fast. And I think patient investors should look at these spaces. They might be a bit volatile, but I think if you have time on your side, that will pay off. Otherwise, I think hybrid funds are good. People with shorter time frame can look at BAF, MAF kind of names or large cap fund. I think mid cap space is squeezed in between. between valuations being high and growth not being that high. So we do think that generally small cap is better space than mid cap because small caps also have obviously much more choice. So out of 600 stocks, maybe 400 are overvalued, but the rest 200 can be good enough to create alpha.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.